Welcome everyone to another stream. I'm your host, Austin, and this is Engineering and Investment. This is the channel where I talk about and give my opinion on different stocks based on fundamental analysis. I like to use FAST Graphs, the fundamental analyzer software tool. I have a good slate of companies for us today. I got lots of recommendations from my biggest fan. As you can tell, I got a new fresh cut today too, so ready for a live stream. The first company on the list is Ondas. So Ondas, I believe, is a drone manufacturer. They have not been around very long. Looks like they IPO'd sometime around 2020. And they have not had positive earnings yet. I won't say it yet. If we look at it, they're projected to have positive earnings this year. So if we go to the forecasting tool, because this is not something we can look at historically, wow, that is an ugly chart. So I'm not even sure where to take this. Forecasting with there's nothing showing up. That's with earnings. Maybe if we look at free cash flow. Okay, so that actually something shows up on the graph. That is something, at least we have a start here. This company would be something that you're not looking, or that you think they have some sort of value other than what they're presently doing. You think that they have a lot of earnings potential in the future that hasn't been realized yet. But so far, the fast graphs make it look really ugly. We can see what Finviz has to say and look at a few more metrics. While we let this load. Well, maybe. Finviz is not looking like it's working that well for me right now. Ondas is a small niche tech company focused on industrial wireless networks plus drones for critical infrastructure. So it seems like what they do is they set up, like, there's a fly buzzing around my face. Looks like nope, I did not get it. If you were to think of it like if your home was one of these critical mission critical industries, it would be like setting up a drone network around your house. And so it's not just the drone itself, but it's the network involved with autonomous drones and ensuring like a security system, communications, location tracking. So it's more than just the hardware piece of it, it's the network itself. So if you're investing in Ondas now, you're hoping, they obviously have no history of earnings, you're hoping that all their spend gets them set up in these big, in these industries, so that way they're established, hard to switch, an all-inclusive network, and that in the future is where all the profits are going to be. My browser is not liking Finviz right now, so I am going to go attempt to move back to fast graphs. Hopefully I've been having problems with Finviz on the past few streams. I'm not sure if my nice 8 GB of RAM computer, thanks to the AI boom, has made RAM too expensive to upgrade. But we're just gonna keep looking at fast graphs, and Finviz can do what it's gonna do in the background. We can take a look. I'll just let it freeze with this nice forecasting chart here. As you can see, if you're buying this It's not for any kind of free cash flow in the near term. This is purely because you think cash flow is going to come at least a few years away. Once they're established, they have wireless network, or they're networked in and the network effect happens. Yeah, so this is not a company whose graph looks like anything that I would be taking a look at. Maybe if it gets down back to a really low price, it'd be worth taking a chance on. But based on this graph and how I like to invest, this would be where you would have to think that this would be like one of those high flyer growth shots that you're just taking a chance on. With that being said, let's check out another drone manufacturer. Well, Ondas doesn't manufacture the drones. They incorporate drones within their network. So they might actually, I think they do. I don't think they actually manufacture the drones. They just take drones and incorporate them into the network, which that's a different story. So Kratos, these guys are drone makers for defense purposes. They would compete directly with the company I've been talking about a few weeks, which is AVAV ticker. So as we see, they're relatively old. They've been around since 2006. They fell off a cliff after their IPO, like most things do, and they've just kind of been treading water until all of a sudden drones became a huge thing in the Russia-Ukraine war. Everyone got super hyped up, and they actually started making money too. That was a big difference. And then now we've seen they've collapsed. So if you got caught up in the peak and chose to buy it at the absolute peak when they had and you didn't look at this graph to see what kind of price to return you were going to get, you'd be losing 64% of your value right now, which that is a tough pill to swallow. But that's water under the bridge. That's the history. Let's see what it looks like going forward. If we forecast it based on operating earnings, we have projected 43% year-over-year growth. We got 38% year-over-year growth. Those are pretty good projections. We can take a look to see how the analysts do at projecting. So near term, the analysts, Kratos does very good at beating the analysts' expectations. A little bit further out, it's not as, it's about 50-50 split whether the analysts are accurate or not, and about the same with 2 years out. So we gotta take these numbers with a grain of salt looking forward. This is a solid amount of growth. Because it's in the defense industry and because of war, you might be able to justify a higher multiple. This is still a much higher multiple than I think I would want to look at. It's currently trading at a 67 PE. If it kept trading at a 67 PE, you'd get 31.8% year-over-year return, which is essentially the growth rate of the earnings. If, for whatever reason, the multiple shrinks, it would go down, say it went down to a PE of 47, which is still, that's still a really high PE. But you could still get 14% year-over-year, which means you're not fully capturing the growth rate of the company because you paid too much for it. You paid a premium for that growth. If the PE shrinks even further, yeah, your earnings would be doing well, but the company, you paid too much of a premium for it. So I think this company is still a little overvalued. We could look at it, I want to look at it with free cash flow as well. So maybe okay, so free cash flow, it's still looking crazy. They're not generating a ton of free cash flow. They're projected to grow a lot of free cash flow, and maybe that's part of the premium that people are willing to pay. But at its current juncture, at 8.75 billion as a market cap, it still seems too overvalued for me. I think if I could buy this, maybe closer to going back to PE. If I could buy this closer to a 40 PE, I think that's where I think this sweet spot would be. Let's compare this to because maybe they're similar, and it's just going to come down to picking stocks. So AVAV is another company competing with Kratos. It's a little bit big, or it's a little bit smaller, 8.7 versus 7.2 billion. It's growing a little bit slower, 21% versus 31%. Okay, that's a lot slower. And it's trading down at a 40 PE instead of a 67 because it has a slower growth rate. The analysts are a little bit better at projecting this one, so maybe the numbers are a little bit more sure on these projections. We said Kratos was around since 2006. This company's been around since 2007, so about the same time period. Again, this is another one that just absolutely ripped, and the hype bubble took it away, and as you can see, it's just absolutely been cratering back towards this orange line. And I like to say, eventually the mean reversion comes for us all. So I think we could see it fall even further coming down to this orange line. I haven't done enough digging to compare the apples, or the apples to apples or oranges to oranges, to try to pick between Kratos and AeroVironment to see what's their niche, what's the differentiating factors, what market, are they going after different markets or the same markets? I think that would be an interesting thing, and I'll have to follow up maybe in future weeks to give my opinion on really who do I think is better suited to meet the future needs of their customers, and maybe the skill of the management teams, and really define a better one, because it's an interesting field that I definitely want to invest in. It's just I haven't done enough research, and it's not my sphere of expertise. My sphere of expertise is in engineering, particularly in opinion giving, because that's my job currently, is I give my opinion. That's what I do. So now I'm doing that job, but on YouTube, and about stocks instead of uranium. So let's check out the next one on the list. Was sticking with technology, Snowflake. So Snowflake has just started earning money. That is great. They have there's a lot of growth projected here, but we're still well above what the growth rates, the orange line. So we got a projected 39.5% growth rate, which is fantastic growth. This is a much bigger company. This is a $100 billion company. They're a software company that's they're becoming more and more integrated into what's it called? Enterprise softwares. So like my brother uses Snowflake for whatever data he does at whatever bank he's working at now. So I'm still not 100%. He's explained it to me, and it's something about data management and data integration, and it sounds to me similar to how SAP works. So if they're a competitor to SAP, that's interesting. I use SAP at my job. I've heard that if you call it SAP, I've heard it both ways. If you call it SAP, you're a noob, and if you call it SAP, you're a noob. But I call it SAP, but also SAP, just whatever I'm feeling during the day. But we're not talking about SAP right now. We're talking about Snowflake. So it's an enterprise software. a data management system. They have great growth, but you're paying a premium because there's a lot of hype. It's one of those Silicon Valley hype fests. We can see if it trades based on operating free cash flow, if there's more of a correlation. So we saw at one point this price came down, touched the orange line in operating free cash flow, and just took off right back up. We can look at forecasting along those lines too. So let's forecast with operating free cash flow. Yeah, so you're paying a huge multiple. It's just, to me, when you pay a huge multiple, there's no margin of safety because the multiple can always shrink. Because say someone gets scared or the market goes risk off, there's a lot more room to fall when you're paying a premium for a company like this. Not to say it's not a great company, not to say they're not doing great things. It's just you're paying quite a premium for it. It's one of those, if there's a big dip, like this big dip, that probably would have been a good time to pay. But at this juncture, I think it's too pricey. Another company, just moving right along here. We'll check in on ServiceNow, which was another pick. All right, so we got a big dip according to this orange graph, but this orange graph's not always the most accurate picture because you see this is a 47 PE, but if we forecast it, we're not going to be looking at a 47% growth rate. We're looking at 20. So this is a decent range to be paying for it because it's a software company. They take it on the chin with the AI fears. I mean, $115 billion is a big company. 20% operating growth expected. So if it keeps trading at the premium multiple, then you're looking to get 20%. I mean, that's right in line with what you want to get. That's a really good investment if you can keep getting 20%. I would say that anytime this dips below, like gets to around a 25 PE or below, that's probably a good time to buy. Mind you, as I'm saying that, it's probably worth saying I'm not a financial advisor. I don't know your situation. I am just giving my opinion on stocks. So they are really good at beating analyst expectations, and the analysts are really good at projecting what they're going to do. I think that's because software as a service is relatively easy because you put in what's my monthly subscription rate and price per seat and my however easy to project, like I'm going to get this many new customers and my customers are going to add this many seats. I think that's part of the premium multiple they trade at, is because it's that easy to project. And I think it's taken for granted how easy or how much our society runs on how easy it is for an analyst to project something based on an Excel spreadsheet. So let's take a look at it according to operating free cash flow projections. So if we're going based on operating free cash flow, this looks relatively undervalued. Like I said, it's probably, I think if you're buying at these prices, you could be slightly above to full value. So you got a good growth rate. I think the AI fears are overblown. I don't think that software is going to be that doomed. I'd been mentioning, I think the previous streams, I thought it was a little overvalued. I still think it looks a little bit overvalued, but you'll probably do good if you invest in this company. That's just my opinion, yo. We'll check in on another company we talked about a decent amount, NRG. We can just start on the historical. Now this is a utility operator. So with that being said, we got the price being in line with the orange line. It's looking like right at fair value. They operate utilities in Texas. the good part about utility operators is they have a regulated industry to make profits. I mean, 20% operating growth rate, that's crazy good. They pay a little dividend. I mean, that's always nice. 28 billion is not the biggest, so they definitely have a lot of room to grow. This company I think this is a winner. This is something I would like to invest in because I like energy. I like stable. I like things that aren't overvalued, relatively boring. Electricity is not going away. It's one of those industries that just isn't going to go away. With that, so also talking about an industry that's just not going to go away. This was another viewer recommendation. Kroger. This is an interesting one. So this, for everyone who doesn't know Kroger, because they probably don't live they have a different grocery chain. This is a grocery store. So, consumer staples, people, I mean, I shop at Kroger. I think Kroger is decent. We got the black line underneath the orange line, but it usually trades underneath it. The blue line is always under the orange line. So, 13 PE. So, we're looking at, according to this chart right now, we're looking at it's a relatively undervalued. It pays a nice little 2.7 dividend. You know, it's good to get reinvested. Since the normal trades under the 15, we'll just put the normal up. I like to use the 10-year normal if we put the 10-year normal up, we'll see that if you invest now and you stay on with the projected growth rates of 7, 6, and 7 and the 2.7 growth rate or the dividend, that we could be looking at a nice little 14% year-over-year return, which if you can get 14% on everything you're buying, you're doing a great job. So $35 billion market cap. Wow, they beat earnings a lot near term, and the analysts are pretty good at projecting. So these numbers, I mean, it makes sense. It's a grocery store. Everyone buys groceries. I think Kroger looks pretty good. This looks like if you like stable, boring grocery stores, which, you know what, that sounds like something that I kind of would like. Stable, boring, low multiple. You're not really gonna, I mean, everybody has to buy food. I think their biggest worry is Walmart coming in to eat their market share. But people pay a little bit more not to have to shop at Walmart, right? Excuse me. So, with that being said, I think Kroger, they look good. I think they look good. I want to switch. Everything that ties these companies together that I'm looking at tonight are suggestions. So if you guys have suggestions, I think this is a good point in the stream to say. If you guys have suggestions, leave them in the chat. Leave them in the comments. Like the video. Tell your friends about it. If you got a friend that it's all about a stock, I'd be happy to give my opinion on it. I'm a professional opinion giver. So, yeah, so subscribe, like the video, turn on notifications. I try to do this once a week. I live a busy life, so once a week, maybe every other week. That's what I've been doing. But I've tried to do once a week. So if you have suggestions, they'll for sure make it on the show if you comment them. So with that being said, the next one, Toast. So those of you who don't know what Toast is a full restaurant back-end managing software. So they do payment processing, they do tables, they do like tables as in they like lay out your restaurant, do scheduling, reservations. Basically, if you want an all-in-one restaurant management software, Toast is the go-to. And I've been seeing Toast pop up everywhere at restaurants around me. So just anecdotally, they're growing. I've seen them a lot of places. So they IPO'd back in 2021, and if If you invested at IPO, you've just barely been, you're still waiting to get your money back. But as we can see, their earnings look like they're growing a lot. I can for sure know that they've been around. So growth rate of 26% projected. I imagine this is another one where I don't think the analysts have a big history on this one yet. But I can imagine that this one would be a relatively easy one to project because they're sticky. There might not be a lot of customer turnover once they get in. There's a big network effect. They would be hard to switch once they've got their claws in on every restaurant. So Toast looks pretty good right now. It's based on its projections. It's come right into it's in, I would call this full value, right at fair value, but because it's at fair, you're buying a lot of growth at fair value. This is a good place to be. I would say this is tied pretty, this would be a way to, if you ever wanted to open a restaurant but realize that opening a restaurant is a terrible investment, but you really want to be in the restaurant space, then Toast might be a great way for you to be in the restaurant space. They say the only way to be a millionaire in the restaurant space is to start as a billionaire. So that's what I've heard about being in the restaurant space. But I think Toast at this juncture, this would be a great fair value play to get into the kind of the fintech tech type software industry that's really sticky. I would just say this is probably a company that's really tied to the consumer and people going out to eat because it's so connected to restaurants. So that would be my caution. If you think the consumer is going to stop spending at restaurants soon, that would be your risk with Toast. But Toast, I think they look pretty good. They've been convenient at the restaurants I've been to. I actually stopped in Chattanooga and talked to a restaurant owner and I noticed they were using Toast because she was a one person shop doing biscuits, and she said Toast was expensive and too much, like not too much, but she wished for like a single person in a small setup like she had, it was not ideal because it seemed like it was built for bigger restaurants. But she was using it, she was trying it out. She said she was iffy on it if it was really getting her value out of it, but that's one anecdote. So Block changed to XYZ ticker. This is Jack Dorsey's Square, and they're the payment processor. So this is when you go to a food truck and they got Square. This is Block. For whatever reason, they changed from Square to Block. I don't really get it. Again, this was another suggestion by a viewer. So if you want to get your suggestions answered, leave a comment. I'll check it out. Put it in chat. So we got 63% growth rate, 30%, 27%. So 30%, 33% projections. Let's check out how the analysts do. Pretty good short term. Far term, it's kind of a coin flip. You don't really know. You don't really know what's going to happen. I would say, again, with Toast, you're tied to the consumer, essentially. Toast is more direct. It's directly restaurant management, whereas Square is any small business, not just like I've only really seen Square at like food trucks, because food trucks stop outside my work, and occasionally I partake in a nice burrito or something like that, but I have to use Square, which it's Block, but whatever. I would say that their biggest competitor would be like, what is it called? Global Payments Network. Apple Pay is a big competitor. But based on this Fast Graphs charts, it looks really good. It's just it seems like there's not really a moat to this kind of stuff other than branding, because a lot of these companies pop up, fintechs, but 33% operating growth projected. That's and at the low multiple that it's at of 25 compared to the 33% growth rate, this could be a great play. My opinion is the charts look good. I'm wary about investing in the payment processors because a lot of them pop up here and there. Like there's PayPal and Venmo and Apple Pay, and I mean it's just kind of, there's a lot of people in the space. There's another one. Okay, I think I hit all the viewer ones. I was going to follow up on. I've done some follow-ups. I can follow up on a few things we've talked about in the past. See how Owens Corning's doing. There's buyout rumors for Owens Corning. So this is a very cyclical home buildy type stock. They are in the midst of the down cycle as we see earnings dropping, but analysts are expecting earnings to come back up and re-up cycle here starting in 2027, or at least, yeah, starting in 2027. The analysts are pretty good with this stock, and this stock is pretty good at beating those analysts. So these numbers are pretty good to take into account. So if you project it out a few years, could be looking good. There was apparently Carlyle was doing a bunch of tender offers at Owens Corning. I don't think Owens Corning is very interested in selling. The board has made it clear, but if there's ever a kind of hostile takeover, that'll drive the share price way up. So I'm happy owning this company. Full disclosure, I own this company. I think that we're seeing coming from the dregs of the down cycle. We could see a bright future ahead. So I'm just going to keep following up on stuff we've talked about in the past. So another company I own, Enterprise Products, they pay a nice hefty dividend at close to 6%, and they have 27 years of raising their dividend every year. And this is one that technically is it's return to capital by it because it's a limited partnership. So don't own this in your tax advantaged accounts because it already has a tax advantage. But it's at full value if we look at forecasting. So right there, 20% year over year with 6% dividend and 9% growth. I think it's projecting a little bit of multiple expansion. So they are a bunch of natural gas pipelines, so tied to the utility infrastructure. I know what I want to talk about because the nuclear renaissance is happening, and there's a new IPO coming up soon. So if we look at Oklo, or Oklo, whatever, $6.7 billion for a company whose license was... So for those who don't know, in the nuclear energy industry, you need the NRC, Nuclear Regulatory Commission, are the people that you basically have to approve your design and operation and all that. Well, Oklo's design was rejected by the NRC as not being specific enough of how they're going to run. So you are paying $6.7 billion for a rejected design. I could design something and get rejected. So if you want to give me $6.7 billion, I'd be happy to take that. Because I think anybody can come up with a design that is rejected. So this company, I don't think, to me, they don't have a future. The CEO is cashing out shares. Like last quarter, he sold over 200,000 shares. To me, this is one of those pipe dream. I don't think it's going to happen. financially engineered for a bunch of to enrich the investors. They are backed by Peter Thiel and Meta and Sam Altman, so all the world's worst people. With that, but I think those people probably already cashed out and took their profits and ran, because Meta's already saying that they have oversupply of GPUs, and Aquila is supposed to build their reactors to power these new data centers. And if Meta already has an oversupply, are they really going to build a nuclear reactor to power their oversupplied projects in the future? That seems crazy to me. Another one of those is, we'll talk about X Energy, which is another one of these. The difference with X Energy is they went with a much more proven design of a nuclear reactor, and they have NRC approval to at least manufacture their fuel, and are working on get it. They at least haven't been rejected yet. So at least you're paying $6 billion for a company that hasn't been rejected yet. So I'm so skeptical of these companies, but I know that we need more nuclear power in this country because we need to find a way to generate electricity. But a lot of these seem like cashing in on the hype. Let's see. Another energy company that's not nuclear but is energy is Bloom Energy. Fun fact, I know somebody that used to work there. Wow, they actually are projected to make a lot of money. Alright, black line is way over the orange line, but if we forecast out, dang, they're really growing. What happened? 60 billion. So I know wow, the analysts are awful at projecting. Take all of this chart with a grain of salt, because they are so awful at projecting. Oh, my mouse is freaking out on me using the trackpad. Alright. Zoom out. Zoom out, please. Oh, please zoom out. Okay, there we go. So take all these numbers with a grain of salt, because the analysts are awful at projecting this. They are trading at a huge multiple, so if they miss any of these estimates, you'd be way wrong. So this is one of those, I guess, high risk, high reward, 50% annual return per year, or the analyst could be dead wrong. This is a company I want to look into more, because I was anticipating just picking up a graph that looks atrocious. I was not anticipating it to actually have earnings and look decent. I used to own Bloom Energy years ago and sold out for a profit. I think I doubled my money and sold out instead of riding and getting a 10-bagger. I think that's the hardest part about getting 10-baggers, is not selling when you have a 2-bagger. But you know what they say, you never go broke taking profits. Let's just keep looking at stocks. You know, we looked at Amazon. We looked at Amazon a couple weeks ago, and I said it looked a little bit undervalued. They just reported it looked like they had pretty good earnings. I think everyone knows what Amazon does. I think the biggest worry with Amazon, I would say, is their free cash flow has gone negative. So, not according to this graph, but for the most recent quarter. So, data centers, AWS, everyone knows Amazon. Amazon went up 15% because they had really good earnings. Amazon seems like it's still a great play. Black line is still way under the orange line. AI is still driving the whole market. Let's talk about the greatest financial. But this company is CoreWeave. For those who don't know, CoreWeave is a neo cloud provider, and what they do is they build the data center and buy the GPUs, and then they rent the GPU space to those who need it. They have taken on loads and loads of debt, and they don't have any data centers built, and they haven't had any customers yet. And this company was essentially propped up by NVIDIA to sell or to buy NVIDIA chips. That's the whole. This company exists to prop up NVIDIA earnings, and NVIDIA even backstops CoreWeave's debt by saying if they don't get customers, then NVIDIA will rent the GPUs back from them. So it's just one big circular accounting gimmick, and this CoreWeave is just one node in the circular accounting. So beware if you want to invest in this company. Like, that's what, you see 79% earnings growth, and it's projected. You can get worried with that. So I, for one, am not a big fan of them, if you couldn't tell. I think the company I want to talk about again, ACOM, they are a company that I'm looking to buy, I think, coming soon, full disclosure. They're up in my wheelhouse, which is engineering and consulting, with government contracts. So they're looking undervalued. I think they're just beat up by the general market, and they pay a nice little dividend. They got out in front of their skis and have had a nice fall, but I haven't seen too much what the bad news is to cause the fall other than just falling out of favor. They're still projected nice earnings growth. They pay a little dividend. So it gets right back to what it's been doing, and you're making 26% per year. That's a great return. And another company we talked about last time, Amentum, if I can spell it. Amentum Holdings. Now, this company is really in my wheelhouse of knowledge. They manage nuclear sites, so like Hanford site, UCOR's cleanup in Oak Ridge, Savannah River site. So there's a ton of money to be made in those spaces. It's crazy how much money those contracts are getting. So, and it's one of those spaces where people don't know about it. Who knows about the nuclear industry? Nobody really. I mean, tech bros are starting to get into the reactor space because of AI, but this is one of those companies that's in the space and actually they're actually operating. So, and they're in my sphere of knowledge. I think this company is going to be great. I think. I always think back because in the nuclear space, it's all about the mission that matters, securing the nation. And the colloquialism we say at work is, yes, execute the mission, which is secure the bonus for the executives. Because the people that own these companies, they get paid so much money by the government to operate these places. And this company would be a chance to take ownership and actually your chance to get your own little slice of that grift that is getting paid by the government. So, and ACOM is similar too. I mean, Amentum was spun off of ACOM, so that's kind of what I have for today. I would like to go to FinViz and go through the screener some more. I'm sure my brother would appreciate looking at Apple because he owns Apple and he likes Apple, and he loves Apple products. So Apple is the upper echelon of companies. They don't spend all their free cash flow building useless data centers. They trade at a huge premium because they're Apple, but they're probably just going to keep going up because they're Apple. I would probably, if I wanted to buy some Apple, I'd wait for a better valuation, but a better valuation may never come. So that's kind of Apple. I mean, it's above the line, but But Apple is always above the line. Not always, if we look in the past. If we put the blue line up, it just, well, it's always traded above 25, essentially. If we go back to forecasting, let me put the normal multiple up instead of the growth rated multiple. 10 years. I mean, it's clearly a lot higher than what multiple historically the market's put on Apple, but so to me, there's a lot of risk with them right here, because if you get multiple compression, I think you're paying a big premium for Apple at the present moment. But and if you're an Apple owner, you've seen a nice run up. It looks good. Yeah, everything looks good from here. I think next week I really want to package all my opinions on the AI bubble and look at the hardware companies like TSM, Samsung, SanDisk, Marvel, Micron, all the above, Intel, and really give a full rundown on what I think is happening. Talk about the circular financing, because I think right now, obviously this tool relies a lot on the analyst projections, but if all the analysts are blinded by shiny new object Apple and are just selling essentially sell-side research, then I think this tool could be flawed. So I think the AI stuff, but I'll dive deeper into that next week when I really want to hammer out all the AI stuff. 'Cause I think one more time I'll close up with a tried and true charter position, because I think this company is going to be the epitome of what this tool is used for, value investing. As we see, the share price is just so far below earnings, and the company is just generating giant amounts of free cash flow. That's just gonna be used to buy back shares and pump earnings. And that's why you're gonna see this, like, yeah, up to the right, because free cash flow does buybacks, and they're merging, and it's just been so beaten up. It's gonna be, we looked at those drone companies, and they peaked way up, and they get reversion to the mean, and they crash like 60-70%. Well, this is going to be the opposite, where you have giant cratering, and it's just going to revert back to the mean of this orange line, and that's just what history tells us. And I think that's what this tool is good for. So, with all that being said, like, subscribe, tell your friends, leave a comment, tell me what stocks I should look at next. I think what I should do is start doing a running summary of what we looked at, and maybe have a little summary of what my opinion was on them, and come up with a channel unique scale of garbage versus not garbage. So we can workshop that. It's been great talking to you all, and